Thanks, everyone. Please stay seated while the governor leaves. Oh.
And we were just listening there to Gavin Newsom, the two-term governor of the state of California, the most populous U.S. state, obviously the largest economy, a $4 trillion economy, and widely presumed to be a candidate for president in the 2028 election. That is your political coverage, at least for the time being. We get back to the market coverage. Romaine Bostick here alongside Katie Greifeld with a quick check here on the markets. Katie, we came into this year, a lot of bullishness in this market. I think over the last few days, we've seen maybe a bit more caution, some of that tied to some of the earnings that we've seen.
Big time. You take a look at the S&P 500 right now, down about 0.5%. The Nasdaq 100 even more. That is all due to Microsoft, down about 12%. Its worst day since 2020. That is chopping 50 points off of the S&P 500 down, which is more than it's actually down by right now, which really speaks to the pain that you're seeing there. Relatively well-behaved bond market, the 10-year Treasury yield down by about 1 to 2 basis points. And then take a quick look at Bitcoin here, Romaine. A wipeout underway, down by about 6%.
Yeah, a lot of questions here about what the function of Bitcoin is, particularly in this geopolitical environment. And investors really trying to parse the balance, if you will, between what's going on in the political and geopolitical space with the economy, macroeconomics, and of course what's going on with earnings and the fundamentals. To put it all together for us right now is Mandy, head of derivatives market intelligence over at CBOE Global Markets, kicking us off to the closing bells here on this Thursday afternoon. We should just remind our viewers we get Apple earnings after the bell. And I bring that up, Mandy, because this gets to the idea of what the market positioning looks like right now. It seemed like coming into this earnings season, the positioning was relatively optimistic. I mean, has it changed at all?
So we've definitely seen a turn to more cautious positioning in the options market. I would say particularly with retail investors, we're seeing a huge decline in terms of call buying activity and a pickup more in call selling or call overwriting, really taking the view that upside is going to be fairly limited here and more concerned with potential downside risk. And especially with earnings, what we see in the options market is people really focusing on that as a key risk, a key driver. So you've seen single stock volatility, for example, become much more elevated relative to index. That spread actually reaching near an all-time high earlier this week.
Well, let's talk about that single stock volatility. I mean Katie mentioned Microsoft having its worst day since 2020. And really, you don't see these types of moves, certainly not to the downside for a name like Microsoft. And it gets to this idea of how the AI trade has driven everything, both up and down for that matter. And I am curious if we're going to start to see more outsized moves like this on some of these names if they do disappoint on those earnings.
I think that's the setup, and that's exactly why we're seeing this bid to volatility in these single names. And when I say single names, it's really driven by the mega cap tech names. So it's really concern around the sustainability of the AI theme. And if that fails, where else do investors go? So we start to see more rotation trades and more volatility being priced in for the tech names.
Let's break this conversation down by investor type. We're all trying to keep track of the retail investor, what they're doing. What are you seeing when it comes to that self-directed investor right now?
Sure. So they've obviously been a huge driver of markets, and particularly within the option market, we've seen a huge surge in terms of retail trading, retail activity. I think there is a misconception that retail is typically just, buying puts or calls and is just a pure directional bet. What we've seen is actually more and more sophisticated trading behavior from the retail base in terms of types of strategies being deployed. But broadly speaking, in terms of sentiment, as I mentioned earlier, we have seen a more cautious turn in terms of sentiment. So less call buying, more call selling, not quite outright bearish. So I would contrast, for example, what we saw in 2022 from the retail segment, where we saw a decline in bullish call buying activity, as well as a pickup in put buying hedging activity. We're not seeing the hedging activity yet. We're just seeing a pullback in the bullish flow and more overwriting. So people really taking this opportunity to sell that rich single stock volatility to overwrite their portfolio to generate some income.
That's really interesting. Not outright bearish, but certainly a little bit less bullish when it comes to the retail investor. I'm really interested by this line in your notes that you're seeing retail investors getting more bullish when it comes to small caps. We were talking about that rotation, of course, small caps with that big run of outperformance versus the large caps. That's cracked a little bit there. But that's interesting because when you think of retail, and maybe this says more about me, you think about more exciting names, more of those tech names, but small caps. What are we seeing there?
I think that's just a byproduct of this concern around AI and the concentration risk that we're seeing in the market, broadly speaking. And now we're seeing more people shift focus and looking at some of the underperformers. Obviously, small caps have really lagged in recent years. We've seen this, before in the past, but I would say this time around, the degree of call buying that we're seeing from the retail community certainly stands out. It screens about the 90th percentile high on our scoreboard. And we're also seeing more interest also coming from international investors looking to invest in the U.S., concerned about the concentration risk. So, one of the things that we're doing is expanding global trading hours in Russell 2000 index options starting next month to give international investors also that opportunity to trade small cap. So that's certainly been a theme that's resonating to start the year.
I am curious, though, going back to the broader market for a second, when you look at some of the options activity, is there any evidence that people are either buying or selling options around some of the geopolitical issues, basically the issues that aren't related to corporate fundamentals?
Yes, so
Yeah.
I would say there's been more hedging activity overall at the index level, whether you're hedging for geopolitical risk, whether you're hedging for just a potential slowdown in the economy, whatever the risk may be. One of the things that we did know is, skew in the S&P has really steepened to start the year, indicating more hedging activity going on.
All right, Mandy, always a fascinating conversation. Appreciate you stopping by the studio. That is Mandy Zhu. She is head of derivatives market intelligence over at CBOE Global Markets. Meanwhile, switching gears here to the asset management landscape, Blackrock and Partners Group are launching a first-of-its-kind private markets investment account for wealth. Now, the separately managed account combines a mix of private equity, private credit, and real estate funds, allowing clients to invest in a range of private markets through a single account. Here to discuss is John Diorio. He is head of alternatives for BlackRock's U.S. wealth business. John, great to see you in person.
Yeah, thanks for having me.
So let's break it down even a little bit further here, because taking a look at the Bloomberg News article, there's 3 variations here depending on your risk tolerance. Walk us through, why those 3 categories.
Yeah, we're really excited to launch a first-of-a-kind private markets separately managed account. And one of the things that we've been seeing in the market is markets have evolved very, very quickly. We know companies are staying private longer. The debt markets are changing. And so clients we see wanting more access to private markets. The problem is sometimes there could be a lot of friction to going ahead and getting access to that and actually building a diversified portfolio. And so what this separately managed account does is it really simplifies the process, allows financial advisors to scale it, to bring it to more clients. And by doing the 3 different outcomes, we can go ahead and tailor it to their needs. So we'll have one that's dedicated towards income, we'll have one that is balanced, and we'll have one that's dedicated towards growth. So it's an exciting way for them to go ahead and get a diversified portfolio of private markets and private equity, private credit, and real assets, and make that a much simpler process for them.
And adjusted to your risk appetite, too, which is interesting. I do want to talk about, how you actually bring in those individual investors, those retail investors, if you want to call them that, because everyone is trying to target this channel. Everyone is trying to go after those financial advisors when it comes to private market exposure. How do you effectively compete here?
Yeah, it's very interesting. We did a survey. We did an advisor survey, and we surveyed over 1,000 advisors. And I think the interesting thing from private markets is we actually have seen the amount of advisors that are using private markets increasing. It's over 50% of the advisors now are using private markets. But the average client allocation is still underweight to what most folks are calling for. We tend to call for 10 to 20% in private markets, depending upon what you're looking to achieve. But the interesting thing is the reason as to why 68% of the survey of respondents said that the issue for them was really around portfolio construction education. So if you think about what can drive returns in the private markets, they can be opaque, they can be more complex, and that's what gives you that illiquidity premium, that complexity premium. So they want some professional management. So what we've done here with our separately managed account is BlackRock and Partners Group provides institutional management on top of this to make sure that you get that asset allocation glide path that you want to be on and really try to achieve those objectives of income, balance, and growth.
Why Partners Group? Did they approach you? You approached them? Well, you're BlackRock. Couldn't you have done this yourself?
Partners Group has been a great partner. We've gotten to know them really, really well. Look, we think we're both leaders in the private markets, and specifically, we both have really good multi-asset teams that are designing these portfolios. Partners Group was one of the early movers in the evergreen space, so you've seen the wealth market really provide access to clients. They were one of the first movers. As you know, we acquired acquired HPS at Blackrock. They are a leader in credit, so we really believe these portfolios are going to bring first-in-class portfolio management and expertise to these portfolios.
I mean, speaking of partners, and specifically the idea of how much they pioneered in that space here, does the risk profile change based on what they've been doing in the past and relative to what maybe you think the clients that are funneled through BlackRock will want?
What we're really looking to do is to go ahead and provide clients with some choice here and to simplify the process for the financial advisors. I think the issue with these evergreen products is there's been a paradox of choice. So many wealth clients really want to gain access to what's going on in the markets. And so now there's a lot of private credit funds, there's a lot of private equity funds, there's a lot of real asset funds. And so what we really are trying to do is move the industry from thinking about it from a product standpoint to a portfolio standpoint. And I think that's important because that's really what clients want. They want to get outcomes. And so instead of thinking about it individually, thinking about it holistically is really important to us.
All right, John, really appreciate it. John Diorio, head of alternatives for BlackRock's U.S. wealth business, as we continue to march towards the closing bells with a quick look at some of the big movers, individual movers on the back of analyst recommendations today. Take a look at Zillow, an upgrade over at Barclays to equal weight. The price target bumped to 72. The analysts seeing a few more reasons for optimism, including promising growth trends and improved execution. Those shares, though, down for a third straight day. Next up, First Solar. BMO downgrading the solar company to market perform here. The firm saying Tesla's plans to enter the solar manufacturing industry could be major competition for that company. Those shares having their worst day since June. And finally, Barrick Mining, JP Morgan initiating coverage with an overweight and a $92 Canadian dollar price target. The analyst saying Barrick offers a world-class reserve base with compelling ties to both gold and copper. Those shares pulling back 3% here on the day, but you pull out a larger chart of that over the last few years and you get a sense here of why that upgrade happened. We do now want to stay in that space here with commodities really on fire. A bit of a pullback today in gold and silver. Copper still pushing toward record highs, and a lot of questions as to, well, just how far this rally that we've been seeing in metals can go. Who better to talk to than Timna, Managing Director and Senior Equity Analyst over at Wells Fargo. Timna, great to see you. It's been too long.
Thanks for having me.
What is going on with metals? And by that, I mean, what is actually driving this? There's been a lot of speculation as to whether this is part of some broader debasement trade, whether this is just maybe a bet on economic conditions. I mean, what do you think is sort of the fundamental reason why we're seeing so much interest in this?
So I think you hit the nail on the head. There's fundamental reasons, and then there's other reasons that have to do with the macroeconomic sentiment and other factors. From our vantage point, this is kind of an unprecedented environment of a shortfall in copper that's been long anticipated, but was brought forward by several high-profile interruptions. So the copper market is actually in shortage conditions, anywhere from estimates of 300,000 tons to 800,000 tons this year of a, say, 26 million ton market. So it gets tricky to forecast exactly where copper can go because there is no one who can make up that copper supply, right? So you have to see substitution, you have to see alternatives.
Yeah.
Aluminum, similarly, is seeing an unusual shortage in supply and generally strong demand as well.
Talk about the interplay, though, between that mining and I'm specifically talking about the mining side of it with copper relative to precious metals. There's been some discussion here that at least for those companies that are doing both, that there might be more incentive to put a little bit more attention into precious metals at the expense of copper. Is there any sort of credence to that?
Look, I think when you're talking about gold and to some extent silver, there's a debasement trade, there's a dollar concern, there's all sorts of factors that are causing a buying of gold, but that I don't think that can translate necessarily to hoarding of copper, right? Copper is going to respond. There's just a different dynamic for copper demand than there is for gold demand, and it's not quite the same. So I think there's been a bit of what we've seen in terms of fund flows and ETF appetite for commodities in general. But I do think there's more risk that if you see a big run up in something like copper, aluminum, even nickel and iron ore, et cetera, you get replacement, you get substitution, which you don't necessarily get in gold.
Gotcha.
And it's interesting, I mean, you mentioned ETFs. You've certainly seen that demand for gold ETFs, silver ETFs. It's a little bit of a funkier picture, but just broadly speaking, when we see these big commodity rallies, you always wonder about the miner. And for a lot of, people who don't live and breathe this stuff, I mean, is it too reductive to think, okay, the price of the base metal is going higher, that's going to be good, blanket speaking, for these miners, or is there a little bit more nuance there?
It is pretty much that simple in the short term, right? The price goes up, they're going to benefit. There's no corresponding increase in miner costs necessarily. There's some nuances there, but for the most part, it goes to the bottom line in copper, for example. The medium-term picture is if you do have a sustained price of copper and aluminum that is so much higher than alternatives, then you do start to see that substitution, right? And copper is substituting for silver in some applications in solar. Aluminum can substitute for copper. We've heard up to 800,000 tons maybe of that substitution. And then you can see steel and PVC or other plastic derivatives substitute for aluminum. So I think you'll see some, not right away, but over time, some switching.
Well, on that point, we're getting into really the thick of earnings season. What are you expecting when it comes to what we might see for some of these miners?
Well, it's tricky. Some of them have already reported, and they're reporting circumstances from the December quarter that have nothing to do with the prices that we're seeing going forward. So the market is already anticipating that. And what's interesting from our standpoint of covering kind of more of the base metals is you're starting to see the impact of some of these precious metals. So we have an iron ore miner we cover called Vale that is an iron ore miner, but they have a bit of gold and they have some precious metals, and it starts to move the needle a little bit here. Same for some of our other miners. So it is having a spillover effect into some of these companies and effectively lowering their costs, boosting profits.
Before we let you go, I do want to get your thoughts on the steel companies, which seem to be kind of forgotten in all this. And I'm just curious as to what actually is the upside, if you see any, for this year for those names, and primarily some of the names here, the last couple names here in the U.S.
Yeah, steel in the U.S. is a bit of a different animal, I think, as you point out, because steel prices are responding to Section 232 tariffs, which we think may stick a lot longer than the market might have anticipated. So we think steel prices might stay for longer, but might have less upside, so it might be stickier. So you might be able to get more confident in the staying power of steel because it's not just about some Chinese speculator in some cases. So there's actually support for steel, like I was mentioning, perhaps replacing aluminum, and it hasn't gone up as much of aluminum. So the domestic market has responded with supply. I think President Trump is happy about that, and I think that means the tariffs are here to stay.
Is the capacity there?
There has been a big increase in capacity in recent years. This year also we'll see a bit more of that. So the U.S. could be self-sufficient in steel very soon.
All right, Timna, gotta leave it there. Great to get some time with you. That is Timna Tanner. She is Managing Director and Senior Equity Analyst over at Wells Fargo. Now, coming up, the weight loss industry is booming, and our next guest cashing in on that fast-growing category. Zach Reitano, he is the CEO and co-founder of the digital health company Ro. He joins us after the break. Don't go anywhere. This is The Close on Bloomberg.
3:30 p.m. here in a chilly New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these markets, also keeping an eye on the Super Bowl. I guess that's a transition.
Yeah, that's where we're all going to be on Sunday, Katie. Or next Sunday, 2 Sundays from now.
Well, we're all going to be watching the commercials, and it was interesting. We saw Ro, which is, of course, a digital health platform, debuting its first ever Super Bowl ad starring none other than Serena Williams. You can see her on her screen right now.
Yeah, okay, I'm buying.
The idea,
I mean, whatever Serena's selling.
Exactly. Here we go.
Look at that.
The idea is it's part of the Healthier on Ro campaign. It's going to be a 30-second spot, so keep an eye out for that. But it's interesting. I mean, we know that weight loss drugs are all the rage, and we know that there's a lot of these digital health type platforms that are basically trying to say, come to our platform and
Yeah, it's taken off. I mean, obviously what seemed like a niche business a few years ago has now become a big business, and a lot of questions here about where it goes next.
Yeah, well, let's talk to Zach Reitano. He is the CEO and co-founder of Ro. He's sitting to our right. First off, Zach, it's great to see you.
Thanks for having me.
So it's interesting. So, of course, you have this Super Bowl ad with Serena Williams. You also work with Charles Barkley as well. You see those ads in the subway and on the PATH trains. I am curious what the ROI is there when you think about these celebrity spots and celebrity endorsements, because a 30-second spot during the Super Bowl, I have to imagine that's quite an investment.
It is. We think it's absolutely worth it. We're really excited about telling this story with Serena. You've called out our first announcement in August with Serena was really about debunking the myth that GLP-1s are a shortcut or in some way a shortage of willpower or self-discipline, and there's no one that has more of that than Serena. This second campaign with Serena and Charles, but also everyday Ro patients, is really about telling the story of healthier on Ro beyond the weight loss. So in the commercial, you'll see her, she's calling out that she has less joint pain. On Oprah's podcast, she said she had knees like Megan. Her blood sugar levels are better than ever. And her cholesterol's down 30%.
Can I ask you a dumb question, though? I mean,
no dumb questions.
Are you
You can ask me whatever you
allowed
want.
to make those claims? Because, I mean, when the GLP story came out, it seemed like most of the marketing was towards either people who had diabetes or like severe obesity and other health problems. And you seem to be saying that there are other benefits to taking this beyond just me wanting to lose 30 pounds.
That's the most incredible part about these medications is when you think about when they first came out, they were diabetes treatments. And they're obesity treatments. And now they are FDA approved for diabetes, obesity, heart disease, sleep apnea, kidney disease, liver disease, and they're being studied for substance use disorder, neurodegenerative disease, pain management, and the data is really strong in clinical trials, people seeing reductions in inflammation in 2 to 3 weeks and improvements in their cholesterol in 6 or 7 months. So it's really tremendous.
I want to talk about the form, how people are taking these GLP-1s, because the big news in January was that Novo was going to start selling a pill version. We know that Eli Lilly is expected to do the same in the next couple of months. What kind of demand are you seeing there? And for the customers who are opting for the pill, are they switching over from the shot, or are they new clients altogether?
That's a fantastic question. As short as possible, I would say the demand for the pill is beyond what anyone expected. We expected it to be tremendous, and it's an order of magnitude more than that, and it's really been incredible. And I think it's because with this product, you have a better form factor for many people. It's more approachable. It's more affordable. 18 months ago, they were only approved for diabetes and obesity. 18 months ago, they were also $1,300. Now the starting price is $149. Right? So the initial price has come down 80, 90%. And the efficacy is there, which has never been the case with oral options. So patients on treatment lose 16, 17%. So you have an equally effective product that's more affordable in a preferred form factor for many. It's market expanding versus cannibalistic.
What's your relationship with the drug makers right now? It seemed like for a while there was kind of a little bit of a back and forth here with regards to what you were selling, whether they were completely on board with it. Has that all been worked out?
We've never had any challenges with pharma partners. The way that we think about it is our priority and really our allegiance is to the patient and the provider. And so we want to make sure, which Ro does, that we have the absolute best products available for them, which is why we've integrated directly with Novo and Eli Lilly.
And they're okay with you selling the compounded version as well?
In this instance, we're just a distribution platform. So Ro does not market or promote compounded products. We actually promote access to the branded products by giving patients a free insurance checker so they can check their insurance for free. And if they do, actually their first month on Ro is entirely free. And then they can go through and we have branded products, we have cash pay, we have insurance. It can be delivered to their door, sent to a local pharmacy. So for us, we're a distribution platform that lets patients and providers navigate what's best.
Well, when it comes to the different drug makers, obviously we've already talked about Novo's pill, which is available on your platform. When it comes to Eli Lilly's pill, which again, expected in the next few months or so, are you anticipating to have that available on Ro at launch, or what do those discussions look like?
Yeah, so I think we've seen both companies. I think the really cool part for us has been, these two companies have competed for a century, right, over 100 years. And what they compete on is actually who can better serve patients from a cost, quality, and convenience perspective. As they've both shifted to consumer, you've seen that competition increase, and the speed with which they've both moved has been incredibly fast, and it's step up. So you see them both going direct, you see them both coming out with pills, you see them both competing on price and different promotions and distribution channels. So Ro is the leading provider of branded GLP-1s in the country, so we expect to continue to be able to offer the best for our patients.
All right, Zach, really appreciate you coming in.
So much.
Obviously, a fascinating business that continues to grow, and of course, a big Super Bowl ad set to debut at the Super Bowl in a couple of weeks. Zach Reitano, Ro's CEO and co-founder. We do have some breaking news right now. This on Amazon, and more importantly, on OpenAI. The Wall Street Journal reporting that Amazon is in talks to invest as much as $50 billion in the latest funding round for OpenAI. And apparently these negotiations are being led directly by Andy Jassy, Amazon's chief executive officer. This is according to people that the Wall Street Journal spoke to who chose to remain anonymous. And this just gets to this. You go back to just this whole idea of how much money is pouring into this and really where it's coming from, right?
Yeah.
I mean, Amazon obviously has a vested interest in this, and the idea that they would pony up potentially $50 billion is a huge deal.
Well, you think about this specific round, it could value OpenAI at $830 billion. That's according to the Wall Street Journal. Remember, SoftBank, just a couple days ago, that news coming, they're in talks to invest up to $30 billion. So just a mountain of money being aimed at OpenAI right now.
And this, of course, would make Amazon one of the biggest contributors to that latest funding round. Amazon, of course, already has a partnership to some degree with OpenAI. We'll try to get you some more details on that as we count you down to the close. Also, Apple earnings after the break, after the bell. So we do have some more coming up here on the AI space when we come back. We do want to talk about macro, and we do want to talk about the Fed, that Federal Reserve decision as to who potentially might be the next chair. Jerome Schneider joins us from Pimco. This is The Close on Bloomberg. President Trump once again saying that a new Federal Reserve chair, the potential new Federal Reserve chair, will be announced. He said that announcement could come as soon as next week. His nominee for the replacement for Jerome Powell. Joining us right now to talk a little bit more about what the market might be comfortable with in that decision is Jerome Schneider, head of short-term portfolio management and funding over at Pimco. All right, so at least based on what we know publicly, it looks like we're talking about Kevin Warsh, Christopher Waller, and now Rick Rieder. A couple dark horses in there, maybe Scott Bessent, and who knows what's going on with Kevin Hassett. The market seems to be most comfortable, at least right now, with the idea of Rick Rieder as Fed chair.
Well, I think one of the things, this has been a prolonged exercise, clearly.
Yeah.
And one of the things that the market's gotten comfortable with is that five-horse race, so to speak, of people in the domain. And so when we narrow it, or at least what the market's doing to narrow it between the three you mentioned, Warsh, Waller, and Rieder, it basically has a common theme. And the common theme is independence of the Fed is going to continue. Now, that might be the composition of the Fed is going to change, and it might be that the chair of the Fed might be slightly more dovish than we're used to. But remember, the Fed is a committee. That committee operates by having votes, by having data that they interpret, and then ultimately having a press conference which those results are interpreted and the Fed chair comes to speak. So I think there might be style differences between what we're used to, obviously with evolution, with Bernanke, and then obviously Yellen, and Yellen to Powell, and then Powell beyond. But in reality, the independence of the Fed is a common theme, and each one of these candidates represent the idea that they know the independent Fed is important not only to the Fed's history, but also to the markets themselves. And I think the administration has an appreciation for that at this point in time, despite all the rhetoric that's going on that this person might be more dovish or more sympathetic to rate cuts than another at that point in time.
So you mentioned those three candidates, Waller, Warsh, and Rieder. I mean, not asking you to pick favorites here, but when you take a look at that lineup, that short list, do you think the market would be comfortable at this point with any of those three?
Absolutely. And from that perspective, there might be, again, style differences. Rieder comes at it slightly from a different perspective than Warsh does. That's an obvious statement. But we might have that as a practical element. And we've sort of gotten a taste of that from the market's orientation with what Jerome Powell has done, sort of drifting away from the econometric styles and the model-driven analysis to something that has a little bit more pragmatic flavor, that has at least a hat tip to the market orientation. So from that perspective, we're seeing the evolutionary process evolve in a proper way. I do think that the Fed is going to be faced with interesting challenges to come as we face an economy that has increased growth.
Yeah.
Obviously, inflation that's going to rise through the beginning of the year and then obviously come back down, but still above Fed targets.
Yeah.
Productivity questions, et cetera. So there's real questions to be answered.
For the market, I mean, I know there's this issue of will the Fed still be independent? Will the Fed still be predictable? And I raise that issue. There's been a lot of reporting about some of the ideas that have been floated by Rick Rieder, at least behind closed doors. So we don't know exactly out of his mouth what he's going to do. But they do seem to be a little bit more progressive in the sense of not just being dependent on past data, but the idea of more structural changes to how the Fed approaches its models and approaches its policy.
Yeah, you might have this notion that the neutral rate might be slightly adjusted within a certain regime, but it's going to take some time for that to evolve. And the Fed's going to be pretty communicative about how the paradigm might shift over that time. But remember, the mandate is employment and inflation. And that's not going to really drift. Now, the nuances of how they manage it, whether it's average inflation targeting or the bandwidth around jobs, might be a slightly nuanced. But that's for the practitioners in the market to iron out. And the voting public is the market. And so if they don't like how it sounds, obviously the rates markets, et cetera, are going to really have a voice and opinion in how this evolves.
And Jerome, we only have a minute left, but when you think about yesterday's decision to hold rates steady, I saw some commentary calling it basically a hawkish hold. Then I take a look at your notes, and you say actually the FOMC is in an accommodative position right now. Walk us through what you're actually seeing when it comes to the stance.
Yeah, when we look at out the market, we see and sort of recognize what Chair Powell recognized. We're at probably the higher end of that neutral right now. Pimco, we likely suggest that there's another rate cut or so to come later this year. But we're also faced with higher growth prospects. And although we're dismissive of potential rate hikes in the future, we also see that accommodation, as you have profitability, productivity, job growth, which is sort of stabilizing, those are positives and don't necessarily justify a series of rapid rate cuts that perhaps some people are suggesting at that point in time. That's where the balance is and provides a really interesting environment, not only for fixed income users, but a real interest rate attractive environment for basically investing at this point in time. So start of the year is pretty good right now for fixed income.
All right, Jerome, always great to see you. That is Jerome Schneider. He is head of short-term portfolio management and funding over at Pimco. Now, coming up, it's the closing bell. We're going to take you there with Venu Krishna, head of U.S. equity strategy and global equity linked strategies over at Barclays. That conversation up next. This is The Close on Bloomberg.
Now we're seeing more people shift focus and looking at some of the underperformers. Obviously, small caps have really lagged in recent years. We've seen this, before in the past, but I would say this time around, the degree of kind of call buying that we're seeing from the retail community certainly stands out. It screens about the 90th percentile high on our scoreboard.
Mandy Zhu over at CBOE Global Markets kicking us off to the close just about 50 minutes ago. As you get toward those closing bells, you talk a lot about kind of how people are positioning in the option markets. And we've heard this a lot on this show over the last few weeks. This is less about sort of what's going on at the broader index level. It's really about the single stock level.
Yeah, the single stock level and the volatility that we're seeing there and the volatility that's expected to come. You're certainly seeing that today as we get some reaction to these earnings. We're going to get into that. But take a look at what's going on at the index level right now. The S&P 500 pairing its losses might take something incredible to get us green in the next 9 minutes or so, but currently down.
That would be awesome if it happened.
It would be awesome.
You'd be telling your grandchildren about it.
Anything could. Anything could. Down about 0.3%. The Nasdaq 100, that's a heavier lift, down about 0.7%. The bond market pretty much unchanged. Even Bitcoin pairing its losses, but still down 5.7% on the day.
And we got some big earnings coming after the bell. Deckers, Visa, KLA, Tencor, Western Digital, and of course, Apple. Full coverage of that coming up as soon as we get to those bells. But before we get there, let's bring Venu Krishna into the conversation, head of U.S. equity strategy and global equity link strategies over at Barclays. And Venu, I do want to start off not with the earnings tonight, but the earnings that we got last night out of two big tech names, Microsoft, Meta, two stocks moving in opposite directions. Meta up more than 10%, Microsoft down more than 10%, despite the fact that the texture of what they reported was kind of the same. I know they're different businesses. Right. We haven't seen this type of this disparity in performance of these two names, at least since going back to 2013. And I'm wondering what that says about what's going on in the market right now.
So two things. One is this sort of move is not surprising. The reason I say that, you were just talking about volatility, one of the things we have noted is that right now we're at historic lows on intersector correlation, intra-sector correlation, correlation within the S&P, and more importantly, of correlation within big tech itself. Just means just these 6 stocks. In other words, returns dispersion is very high. That's the reason why single stock volatility is so much higher than index volatility, right? So the dispersion is there, and we expect it fully for that to continue. But to your point, is it somewhat surprising about the diverging fortunes of these two stocks? Yes and no. The reason I say that is I think we have now entered a critical next phase in the AI narrative. So we have moved now from a rising tide kind of a narrative to winners and losers. And so at any particular time, even if you look at this big tech, the correlations are in the 40 to 50%, so not that high. They were never moving as a group. Now they've dropped even further to the 20, 25% range as the market is sorting out between those business models. So 6 months ago, there was so much emphasis on OpenAI as being the undisputed winner and Alphabet as a potential loser in terms of their advertising business, their search business, and all that. That narrative has changed quite dramatically just in the last 6 months. Same thing with Meta
Right.
and Microsoft, for example.
Well, I'm so glad you brought up OpenAI because that's what I want to talk about. Not a public company, it might be soon, but not a public company, and yet it really matters for public stock indexes. I mean, you think about all the different publicly traded companies that are somehow connected to OpenAI. Amazon, just the most recent example with that news coming from the Wall Street Journal that it's in talks to invest up to $50 billion in OpenAI. What do you make of that when it comes to the AI trade, that you have these private companies really making a splash in the public markets?
Without doubt, right? Because one thing, as you've noticed, is that companies are willing to stay private for much longer. And and with the AI narrative coming in, their valuations have been quite substantial. So the last funding round, I think OpenAI was valued at $500 billion. Similarly, Anthropic, which is another big competitor in the same in the AI space, had a valuation of, I think, close to $350 billion. So these are big companies. And in the case of OpenAI, like you said, it is very central to the whole AI ecosystem, given its tentacles spread in many different directions. And so what's happened, if you've noticed in the last probably a month or two, is that the more exposed names to OpenAI have actually moderated. And the flip side towards Google have done better. So Anthropic is in better shape. Google and Gemini is in better shape, right? And anything linked to the more exposed to the OpenAI ecosystem, whether it's NVIDIA, whether it's Microsoft, whether it's CoreWeave, or Oracle, all that on a relative basis has moderated, right? It just tells you that the market is continuously reassessing as to who are likely going to be the winners and losers over the next medium to longer term. And I think that battle will continue for the foreseeable future. But I think some of these big companies are, we will see where the dust settles eventually.
Do you see any, though, bigger risk in this idea of not just the idea of the CapEx spending itself being out, but the idea that at some point we might start to see some of these big players maybe pull back on that if they haven't delivered?
Oh, absolutely. In fact, we had expected some pullback end of last year. But what ended up happening after the third quarter is they all increased their capital spending. And even this quarter, Meta has once again increased its capital spending expectations. So I think in the short term, there's a race between them, all the big players, because of this platform effect, and nobody wants to be left behind. And so there is, to your point, a real risk of capital misallocation by somebody. Not all. There will be some winners and losers. And I think the question is, how do you sort out who that is going to be and which side?
And we have less than a minute left here, but when you think about all this CapEx that's being spent by these big tech companies, is there a simple sort of line you can draw that, okay, you have Meta, Microsofts of the world still spending a ton of money when it comes to CapEx, that has to be good for the NVIDIAs of the world?
Well, NVIDIA is a winner one way or the other, right? As long as the narrative is in place, because they are almost a single source provider of the chips which are needed for this whole. So I think NVIDIA is in a very strong. So to the extent that the capital spending starts moderating and the outlook for AI cools a little bit in terms of its supposed transformative impact, then NVIDIA will also get affected. But NVIDIA is not trading rich. Its valuations are moderated. And in fact, big tech valuations over the last, call it, 12 months have come down about 10 to 15%, even as their earnings are very strong. So you're in an environment in which, as long as their earnings are strong or stronger than the moderation, their multiples, you'll still post positive returns. And last point I would say is, last year, big tech as a group returned 23% compared to S&P 17%.
Yeah. All right, Venu, always great insights. Venu Krishna is head of U.S. equity strategy and global equity linked strategies over at Barclays. Counting us down to the closing bell. We're just about 2 minutes away from those bells and just a few minutes away from another slew of big earnings, including Apple, which reports a little bit later in the 4 p.m. hour. We're going to have full market coverage of that right here on The Close, a full breakdown of all of today's market action with our global simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stanovic join us from the radio room. Welcome to our audiences across all of our Bloomberg platforms. Another busy day after the bell tonight with some big earnings, including Well, from the second biggest weighting in the S&P 500.
Yeah, looking forward to it when Apple reports at about 4:30 p.m. Wall Street time. And it'll be interesting to see, like Meta did well off of their earnings and that AI story. Not the case for Microsoft. Tesla, which was up initially after it reported aftermarket yesterday, we're seeing it down in today's trade. So I'm curious. Apple is expecting a record quarter, but we'll see what we get when, you know, the AI story for them has not been so good, Tim.
I thought Romaine was talking about Deckers Outdoor.
Uggs, Tim.
That company
on fire.
Yeah, is reporting.
They are
after
reporting.
the bell, too. It's not just Apple. Visa,
They also
KLA
have,
Corp, SanDisk as well, among others.
We're going to bring you all of those names. I do want to point out something amazing happening on the S&P 500. We're down just 0.1%, Romaine. We were joking about whether or not it was actually going to go positive, but it has about 40 seconds. It might get there.
It might get there, but it gets to the idea of a bit of a holding pattern, particularly coming off of yesterday's that sort of duality of earnings between Microsoft and Meta. But we were just speaking with Venu Krishna over at Barclays, and he kind of gets to this idea here that this has basically become a single stock market. And there's a lot of bifurcation out there. According to him, he's saying that the correlations right now are at some of the lowest levels we've seen, at least when it comes to some of those big tech stocks. And you mentioned SanDisk. That could actually be a big part of the story for Apple as we take a look at memory prices hovering near record highs. As for the market, we're not going to close at record highs today here. A bit of a pullback, if you will, or let's just call it softness. The Dow Jones Industrial Average is in the green by roughly about 20 points as we wait for these numbers to settle. We're just going to call it unchanged on the day. The S&P down 0.1%, the Nasdaq Composite down 0.7%, and the Russell 2000, we're going to call it flat, up 1 point on the day. Carol.
All right, let's get to the S&P 500. We've seen pretty much an even split throughout the session, and that's a little bit more to the upside. 286 names in the S&P 500, Katie, higher, 213 to the downside, 4 unchanged.
All right, let's take a look at the sector level here. It's interesting when you break it down, looking at the circle in terms of what was your big, gigantic winner today. It was actually consumer communication services that is solely, not solely, but a large part due to Meta and the huge rally that we saw there. Real estate also popping today. So too did financials and energy. In terms of what didn't perform overall, tech. As you probably aren't surprised, Microsoft having a terrible day. Consumer discretionary also off by about 0.6%, Carol.
All right, guys, let's get to some of the individual gainers as we await earnings to cross the Bloomberg terminal. Got to go to Meta Platforms. This definitely was an outperformer in today's session. Of course, 24 hours ago, we were breaking down their earnings. It's the number 3 gainer in the S&P 500. I believe the number 1 in the Nasdaq 100. That stock, as you can see, up 10% here at the close. There's a lot to say about this company. Check it out on the Bloomberg, but just real quickly, EPS sales beats. The company also gave a revenue outlook that was much stronger than expected, which helped offset really the impact of higher AI-related spending. That has been on everybody's minds, but nonetheless, investors being pretty rosy when it comes to Meta. Just want to mention Southwest. LUV is the ticker. That is the number 1 gainer in the S&P 500. Up about 19% in today's session, reporting results that topped analyst estimates, signaling the fruits of a turnaround after a rather challenging year. Company working to add premium options and has transitioned from its longtime open seating system, we all remember that, to assigned seats as part of a strategy to.
And some of us still love it, or well, I guess I can't love it anymore.
I want my seat. I want to know where I'm going, and I want to be in boarding group number 1.
Okay, sorry, princess. All right. Yeah.
I wear the crown proudly. Do you want to do some earnings?
Yeah, these are crossing the wire right now here. The numbers themselves here look to be relatively in line with expectations. 317 on the bottom line. That's your adjusted EPS number for the first quarter. 314, that was the average of analyst estimates, so a slight beat there. Net revenue at $10.9 billion. The street estimate was looking for about $10.7 billion in cross-border volumes on a constant currency basis, up about 12%. We need to dive a little bit deeper into this release because the real story here is still a lot of concerns about any potential settlement on those exchange fees and how that might affect their business.
All right, well, I'll give you a moment to do that.
I actually have a little bit on that. In the release, I'm going through this. The company says on November 23rd, 2025, Visa deposited $500 million into its litigation escrow account, which was previously established under the company's U.S. retrospective responsibility plan to insulate the company and Class A common stockholders from financial liability for certain litigation claims. The deposit has the same economic effect on earnings per share as repurchasing the company's Class A common stock, as it reduced each of the as-converted Class B1 common stock. Okay, well,
anyway, that's the news there.
Thanks, Tom.
And it's a superseding and amended settlement agreement to release the interchange multi-district litigation injunctive relief issue claims. The settlement's subject to approval by the court. So the lawyers went through this press release pretty closely.
I feel like that wasn't written by a PR person.
Yeah, I agree with you on that. But anyway, that's your answer to the question about litigation, Romain.
Thanks, Tim.
You got it.
know what? You get an assigned seat on the next flight.
I'm still waiting for the interpretation on that. Hey, I'm going to go back to gainers. Cruise ships, they were definitely some outperformers in today's session. We'll bring up the boards for you. Royal Caribbean up more than 18% in today's session. Company came out, fourth quarter financial really squashed investors' concerns over cruise demand. They said demand for cruise holidays keeps accelerating, which could see the liner add as many as 6 additional ships to its fleet. They had a lot more positive commentary, too, about the business. So Royal Carib up almost 19%. You saw Norwegian also up.
Aren't you hip?
I'm really cool, aren't I? Norwegian up about 10%, and then Carnival up about 8.5% in today's session. I'm not really cool, but I try.
Okay, stocks in the green, stocks in the red. Got to start with Microsoft. Shares having their worst day, going all the way back to 2020, down 10%. This after reporting record spending and slowing cloud sales growth, fueling investor concerns about the return on that spending. We spoke to Angelo Zeno of CFRA a little earlier. He's recommending people buy the dip on this sell-off. He said the valuation is compelling, concerned around the Azure number and concentration risk in OpenAI. Kind of sees those as overblown. He's still bullish on the stock, Katie.
Yeah, there you go. Meanwhile, let's go to Deckers, which it owns Uggs, but it also owns Hoka's, of which I am a huge fan. Their third quarter net sales beat estimates. They came in at $1.96 billion. The estimate had been for $1.87 billion. Third quarter EPS coming in at $3.33. You can see shares popping right now and higher by about 4.8% in the after hours, though I will note this company is coming off of a terrible 2025, falling about 49% or so last year. So they really needed some good news, and it looks like they got it. Their full year net sales, they see that at $5.4 billion to $5.43 billion. They had seen $5.35 billion, and the estimate had been for $5.36 billion. So definitely an upgrade there.
Well, let's go over to KLA Corp. That company reporting results, and shares up this year by close to 40%. Shares up last year by more than 100%. Second quarter revenue coming in above estimates at $3.3 billion. Second quarter CapEx coming in above estimates at $105.6 billion. Second quarter adjusted EPS coming in above estimates at $8.85. The company, as far as the outlook goes, sees third quarter adjusted EPS $8.30 to $9.86. Estimates were for $8.96. In the after hours, shares taking a hit, down about 4.4%.
All right, obsessed with these companies, including Western Digital. I mean, the space has been on fire. This one's up almost 300% last year. It's up a lot already this year. Let's go to second quarter adjusted EPS, $2.13 a share, easily a beat. Street was looking for $1.95 a share. Let's get to the outlook, always important. Sees third quarter adjusted EPS $2.15 to $2.45. Sees third quarter adjusted margin 47 to 48%. Sees third quarter revenue $3.1 billion to $3.3. I'm looking for some comparisons there, but you can see the stock already up about 2.25% here in the aftermarket. Again, this is another one of those that plays into the AI trade specifically when it comes to storage and the like. And so here's another outlook. Sees third quarter adjusted EPS $2.15 to $2.45 a share. The estimate on the street remain only $2 a share. So that's a big up.
And I'm fascinated by this, too, not just because of the phenomenal run up in these prices, but then it also offers a read through into what we might hear from Apple a little bit later in the afternoon. Remember, as names like SanDisk and Western Digital rise on the back of pricing in the memory chip space, you have to remember that those chips actually go into devices. A lot of devices, of course, made by Apple. So we'll see how it all balances out, of course, with Apple expected to announce some progress on the AI front but maybe getting a little bit of a drag from some of those prices. And speaking of which, SanDisk out. The share is getting a nice pop right now. Carol, up 10% in the after-hours trade.
Wow.
The company providing a revenue number, $3.03 billion. The street was looking for $2.67 billion, so a beat on that front. Got to dive a little bit deeper in to get the rest of the numbers here, but the knee-jerk reaction to the upside.
Yeah, that one was up more than 1,400% last year.
Yeah, I know. I'm crying.
Are you? Because
Yeah.
you had no exposure?
Yeah, I'm just in like these, lazy little dividend, what do you call them?
Index funds?
Index funds.
Warren
Yeah.
Buffett.
It's not just about buying shares of Crocs.
Warren Buffett?
Warren Buffett, heard of him?
Yeah, I mean, he had a nice run.
All right, we have to wrap. Of course, we're counting down to Apple earnings coming your way at 4:30 p.m. Wall Street time. That's a wrap across platform radio, TV, YouTube, Bloomberg Originals. We have Katie and Romaine, of course, continuing there on TV on the close. Tim and I right here on Bloomberg Business Week Daily on radio. We'll see you again, same time, same place tomorrow.
And we continue our coverage on Bloomberg Television when we come back after the break. To the upside in the after-hours trade, SanDisk and Western Digital. Decker's also rallying up about 13%. But we are going to focus in on the tech space as we count you down to earnings from Apple. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A mixed day once again on Wall Street. A lot of activity, as it been of late, has been in the commodities space. We actually saw a bit of a downdraft today in gold and other precious metals. Copper and some of the industrial metals did get a bid. No one really knows what the heck's going on with Bitcoin. But drift your eyes there to the Nasdaq composite. That's the Nasdaq composite, up about 0.7% here on the day, down about 0.7% here on the day. A big downdraft today, primarily coming from Microsoft, dropping more than 10% after its earnings last night after the bell. A bit of a divergence going on right now in the tech space as we await earnings tonight from Apple.
Yeah, it was a real tug of war when you think about the two big earnings that we got last night. I put some of the big reporters from yesterday, 24 hours ago, on the board. You have Tesla down about 3.5%, but then take a look at Microsoft, down about 10%. Totally different reaction when it comes to Meta, higher by 10%. And let me tell you why. It's our top story this hour. No signs of easing in the battle for AI supremacy. Meta going all in with capital spending set to double this year to as much as $135 billion. You also have Tesla in there. Their planned capex for 2026 is almost twice as much as Wall Street was expecting. And that brings us to Microsoft, sinking the most since 2020 on concern that sky-high spending is eroding returns. Now this, all as investors now turn their attention to Apple. It's set to report results later this hour. And as well, 2025's best performer, SanDisk, Romaine, which reported just a couple of minutes ago.
Yeah, 2025's best performer is SanDisk. It's also the best performer in 2026. And here in the after-hours trade, well, it's also the best performer. Those earnings just crossing the wire right now. Revenue in the most recent quarter rising up to about $3 billion, higher than street estimates. Adjusted EPS coming in $5.15. And get this, gross margin expanding from up to 51.1%. The street was looking for 42%. Joining us right now is Matt Bryson, Managing Director of Equity Research covering hardware over at Wedbush. All right. SanDisk, I'm not sure what actually breaks this cycle. Are we now kind of in, I don't want to say a permanent upcycle, but certainly a prolonged upcycle for this company, for its pricing power, and obviously for its stock, Matt?
I think, Romaine, that you need more capacity to come on to break the cycle, and it takes 2 years to build a fab. So we are, well away from the point where you get more capacity and you finally see kind of this craziness come to an end.
When we start to talk about how we sort of model a company like this going over the next couple of years, what are you looking at in this release, on the conference call, and going forward, Matt?
Yeah, the difficult piece is this is uncharted territory. So I've been covering the space for over 2 decades, and I've never seen pricing move like this. I've never seen shortages that are this substantial. And so, we're looking at gross margins breaking historic highs. And so the difficult piece is exactly how high can numbers go? But at the same time, we know that this isn't the end, right? Numbers are just going to go higher next quarter.
just going to go higher next quarter. Well, I was going to say, I mean, you take a look at some of the price targets that you have for Sandisk, $600. I mean, how often are you expecting to have to update that, just given where the cycle is and where you expect it to go?
Honestly, it's become the norm over the last 2-3 quarters for all the storage stocks and the memory names. So whether it's Micron, SanDisk, Seagate, Western Digital, it seems like every quarter that theoretical peak that we had known previously, it disappears. And so you're left trying to figure out what happens a quarter or two out without any historical precedent.
Yeah, I have to imagine. In some ways, it's an exercise in chasing in circles. But when you think about SanDisk, talk to us about its position when it comes to some of its peers. I mean, you think about the rally that it saw last year, clearly the outperformer in the stock market. But you think about that cycle, that 2 years that it's going to take or so for more capacity to come online. Who is the best position when you take a look at your stable of coverage?
It's hard to differentiate between the memory names. So I would say that it looks like capacity comes on a bit faster in DRAM than it does in NAND. So when I'm thinking about the DRAM cycle, you're probably shorter DRAM right now, but does that cycle end somewhat earlier than the storage cycle? I think there's a decent chance of that. When you think about the hard drive names, they haven't seen the pricing power that we've seen for memory. I think in part because they set up these longer term supply agreements. I think with those names, and I wrote about it, that we move 2, 3, 4 quarters out, you see some of these contracts reset to a point where things were tight when terms were negotiated. And I think they start to see some of these pricing gains. But I think it's an industry-wide phenomenon as opposed to, one player has a significant advantage over everyone else.
I am curious, Matt. I do want to get your thoughts, too, also on what's been going on with Western Digital and the compare and contrast the two businesses and obviously the different types of chips that they're effectively selling or memory that they're effectively selling.
Yeah, so it comes down to the same thing, Romain. It's CSPs have a bunch of requirements for storage. Storage grows with AI, it grows with general compute, and no one saw those portions of the data center growing as fast as they've grown. And so these companies just didn't have their supply set up to deal with this growth. But at the end of the day, what both industries need are new fabs. For SanDisk or Micron, that's a NAND or DRAM fab. For Western Digital or Seagate, it's a head fab, which is kind of like the needle record player. It reads the drives. And for a new fab, it's 2 years. And so they've got the same bottleneck and the same problem in terms of bringing on more capacity.
Dumb question, Matt, though. Do you see any sort of potential for consolidation here?
There is. If you look at NAND, there are 6, 7 players, depending upon how you count them. And in DRAM, we've got 3. In hard drives, we've got 3. 3 seems to be a great number. So I think there's certainly room for some of these companies to combine. Having said that, it's harder these days because all of a sudden it's in the national interest of a number of countries to own technology. And so, will a country let their company get subsumed by another country's company? I don't know.
All right, Matt, got to leave it there. Great to get some analysis from you in the wake of those earnings. That is Matt Bryson of Wedbush Securities. Now, coming up, AI, of course, defining this earnings season. Cheryl Cheng, she is managing partner at Microsoft's venture fund, M12. She joins us next. This is The Close on Bloomberg.
Well, we've been talking about it for, seems like ever. AI, it dominates everything from the economy to the markets and everything in between. And it is now dictating the winners and losers this earnings season. But beyond the headline results, our next guest says category leaders will be those who can scale trust and operability, not just speed or accuracy, especially in regulated or high-stakes environments. Joining us right now is Cheryl Cheng. She's a managing partner over at Microsoft's venture fund, M12, and she joins us here in a chilly Studio 2 in New York. Great to see you here.
Great to meet you.
I apologize for the weather here, but I mean, I'm curious about where you look for opportunities in this AI space, and more importantly, not so much who the winners and losers are, but actually what facilitates that winning, if you know what I mean.
Yeah, no, great question. So M12, as you mentioned, is Microsoft's venture fund. And so we focus a lot on enterprise AI applications, infrastructure, technology. So my purview is on applications, and we mainly look at places where AI applications can dramatically improve the enterprise experience. So it could be back office, it can be customer facing, and so really looking for those levers. That can be in productivity, it could be in accuracy, it could be in actually creating opportunities that never existed before because the technology before it could never do the things that AI can do today.
It's one thing to sort of make those products and push them out, but what's been the adoption? What's been the reception by folks for those products?
Sure. So it is definitely still early days, but I saw a survey recently of 8,000 CXOs across enterprise companies, and 42% of them have now been deploying AI agents in production. So we're definitely seeing the uptake. Is it pervasive and everywhere in the enterprise? No. Early adoption has been in IT, in code creation, things like that. But to give you an example, manufacturing, which you guys talked about a little bit on today's program even, is a lifeblood for a lot of American economy. And we're seeing software products today, AI agents, assist in direct procurement. And that's very important given the globalization of supply chain, how complicated it is, and the direct products that are being manufactured have to arrive on time. So businesses like Diorio, for example, that didn't exist 2-3 years ago, are now using agentic software to make sure that direct procurement happens efficiently and nothing is lost to the gaps. Because if materials don't show up in the warehouse and don't show up on the manufacturing floor, nothing is getting made.
That's really interesting because I always wonder, you know, what industries are actually adopting enterprise AI. You know, we've spoken to various AI companies before, and it seems like enterprise AI is where everyone is focusing, and the speed of that adoption maybe isn't living up to the hopes and dreams. You mentioned manufacturing. Are you seeing any opportunities when it comes to healthcare, for example?
Absolutely, and I do cover healthcare. It's an area I have a ton of passion for. Healthcare traditionally was slow to adopt technology. There is not a doctor's office in America that doesn't still run on phone and fax, which is amazing. But at the same time, healthcare has been one of the fastest adopters of AI, mainly because we do have a labor shortage in healthcare. And so people are not getting healthier. Conditions are getting more chronic, more complicated. And so AI actually becomes a relief to the workforce and also in the, I guess what I would call unequal distribution of care in the US. If you live in a rural area, you may not have access to a specialist versus here in New York, you have access to anything that you need. So AI really helps bridge that gap, and it's a combination of AI plus telemedicine, new clinical models, et cetera. So that's just at the patient-facing level. And then you go all the way up. One area that we at M12 are spending time in is looking at AI for science. And so science can be anything, right? So it could be therapeutic discovery all the way down to the beverage that you're drinking and the new formulations that come from it. And given the amount of research that's out there and the amount of data that needs to be crunched, AI becomes a very necessary tool for new formulations, new R&D, and so we see that in healthcare as well.
Well, one of the reasons I asked about healthcare is because earlier this month I was at the JP Morgan Healthcare Conference in San Francisco, and AI was one of the big topics. I mean, one of the big pieces of news from that conference was that NVIDIA is investing $1 billion in an AI drug lab with Eli Lilly. The ultimate hope is, you know, that's going to help with drug discovery. But when it sounds like you're talking about investing in science, interested in science, that it sort of transcends just that health space.
Absolutely. I mean, so plastics, right? There's science in that, all the way down to like the trash bag that you use, right? There is both material science, chemistry, and even manufacturing science, and all of those areas are ones that AI has the ability to impact, and we're seeing that happen already. And what you saw at JPM, absolutely. There was so much energy around what AI can do for molecule discovery, clinical models, up and down.
I've heard this from a lot of other folks, particularly, when we talk about kind of what's, at least as normal people, what's behind the scenes. I do want to talk about normal people for a second. We are awaiting Apple earnings. And,
yes.
And that's been, when we talk about what, AI has dominated the conversation.
We are consumers.
Most of us are talking about chatbots and things like that I know is very surface level for probably someone like you. But when it comes to the use case for sort of more pedestrian tasks there, do you see that here? Is it coming? And more importantly, is it something that you would even be interested in investing in on any kind of a large scale?
All of the above.
Oh.
So it is here in some areas already. So the example I was giving of like a business like Diorio, right? These are actively being deployed, these agents, making sure that the procurement process for manufacturing companies stays on track, and any small change, it could be a storm that is now making your products delayed, like it allows them to stay on top of those purchase orders. So this is already being deployed. Will there be more? Absolutely, because you need these agents to be orchestrated among each other, because just like a team working together, there are handoffs. And so while there's one function they may be automated through AI, another may not, or it may be automated through a different AI agent. And so that orchestration and that communication is still being worked out, and we'll continue to see that. And all of those are areas that we at M12 and I am personally interested in. So always happy to talk to founders and investors and you guys about those topics.
Well, come back soon, because unfortunately we have to leave it there and await these Apple results. Really fascinating conversation. That is Cheryl Cheng. She is managing partner at Microsoft's venture fund, M12. Again, we are awaiting those Apple results, and the stakes are pretty high. When you think about Apple and the narrative that they haven't been able to yet dispel, that they've fallen behind when it comes to AI.
Yeah, but we still, and this is the idea of where's the bridge here. We talk about a company that's still throwing off $100+ billion in revenue per quarter, and it gets to this idea here as to where that money gets invested. Do they need to articulate an AI strategy? Do they double down on hardware? And of course, some big questions right now also about succession planning, given Tim Cook's now very long in the tooth but successful tenure.
Yeah, absolutely. Those conversations have just increased in volume over the past couple months, and I imagine that they're going to grow more from here. But we do have those Apple results, Romaine, coming in through right now. It looks like first quarter revenue is going to be beating estimates. First quarter revenue coming in at $143.76 billion. That is ahead of the estimate there for $138.4 billion. Also looking like a beat when it comes to EPS as well.
Yeah, I'm going to go through some of the percentages here, because this is kind of the similar story that we've seen in past quarters. Top line revenue up 16% in the quarter. iPhone revenue up 23%. Mac revenue, that's down 7% year over year. Of course, we all have heard from Mark Gurman and some other people at Bloomberg saying that there will be a refresh of that. iPad revenue up about 6.3%. Wearables revenue is down. I don't know if you had actually gone through the Greater China revenue or not, Katie, but we look at that. That's up 38% to $25.53 billion. Margin expansion as well, looking at roughly about 19% growth on gross margin.
Yeah, really interesting to see these numbers come through. And, at a broad category level, it looks like a bunch of beats across the board. You can see that reflected in the share price now higher by about 2.5% here. A lot of questions, though, about what is going on when it comes to the strategy, product versus software, and, of course, what the AI outlook is. So let's ask some of them now to Walter Piecyk. He is TMT analyst and co-founder of Lightshed Partners. I'm pleased to say that he joins us now. And Walter, you've had a couple minutes, a second or two, to take a look at these results. As I said, when it comes to revenue, when it comes to EPS, when it comes to iPhone revenue specifically, beats across the board. What do you make of it?
I mean, I haven't had a chance to really delve into where the numbers are, but obviously in 2025, you've had this situation where the replacement cycle has stopped lengthening. It was a 10-year lengthening of the replacement cycle. So now we're going into 2026, and what the next product is and where the company is really going to be positioned in terms of AI. AI has been this kind of overhang on the stock that even, as you can see, that even though they've done well in recent quarters in terms of revenue growth on these lines that you were just identifying, even for this quarter, you've seen a contraction in the multiple and underperformance in the market, and the stock obviously starting off the year down because of the continued concern. I actually would have thought that the deal that they did with Google in order to, develop an AI strategy, which is now multiple years in delay, would have helped to buoy the stock more. That was the big overhang on them.
Can I just stop you there, Walter, on that point, though? I mean, I know we have to wait for the conference call to get a little bit more details, and I assume they'll be asked a lot about that. But do you see that being a potential boon to them, assuming they actually execute on it? I know there's a lot we don't know in the details.
I mean, if they execute well, and you turn Siri, which is could be a very personalized assistant for the consumer, that can certainly help them. If they don't have an AI strategy, and we move towards agentic, and I think you just saw this week where the Chrome browser and the Gemini assistant is now going to do more things than it did, just a week or two ago, and even what was added to Chrome was not that long ago, where you could have some Gemini integrated. If Apple doesn't come up with an AI strategy, and there's better agentic features in Android, that is a long-term existential risk to the market share. Not only to go to Android, but obviously you've heard a lot of dialogue about additional, ways that we're going to communicate with our data. Even, I think Mark Gurman had a story about how Apple's coming out with their own PIN, or maybe it was someone else at Bloomberg, very responsive to the rumors in the market about what OpenAI and others are developing. Why? Because we're in this, this technological change where how we're going to interact with our data is going to be very different, I think, 5 years from now than what it is today.
Do you have any concerns, though, about this partnership with Alphabet, particularly given some of the past, let's just say, litigation and regulatory issues, and also just the idea that these are two companies that, quite frankly, have different aims and different visions at some point, and I do wonder if they collide to a certain extent when it comes to how exactly that data, all that data is used and stored.
I mean, concerns as an American citizen or concerns as a financial analyst? Because Google was determined that they are a monopolist, and yet the conditions that were placed on them were effectively non-existent. And then soon thereafter, you saw this tighter relationship between Google and Apple. There's certainly nothing in our government that's curtailing these large companies from getting bigger. Certainly, there's definitively risks in that in terms of competition. So sure, as a citizen, I'm very concerned about that, but over the next 3 years until we have a next president, regardless of what party that comes from, I think it's kind of clear sailing for these mega companies to continue to basically act and take advantage of the already monopolistic strength that they have in their individual markets.
And I do also want to get your thoughts on potential succession here. Of course, Romaine and I were chatting about it a couple of minutes ago, and it's a conversation that you really helped start earlier in 2025 in July, when you came out with a note that you basically said Apple should consider replacing Tim Cook as CEO. You wrote at the time that Apple now needs a product-focused CEO. A couple of months have passed since then. Is that still your view? Has anything changed when it comes to how you think Tim Cook is managing this business?
Well, all of our concerns about the progression of AI at Apple were accurate and came true. And they didn't deliver on the things that they said they were going to deliver. And now the strategy is effectively to turn over the engine to Google. And I think a lot of people are giving them, benefit of the doubt that you can use this Google engine and still perform. I'm sure he can deputize key people within Apple to try and execute that, but he still has been at the helm, and not really delivered essentially new products. He's been a great CEO for what Apple has needed, over his tenure in terms of production, but in terms of new products, and we're going through a massive product change and software change in the market right now. And it's one thing to deputize someone, but at the end of the day, the buck stops at the CEO. And I think you need the leadership there in order to take them to the next step. So look, I think there's been some stories. I think Gurman thinks one thing. Other people have heard other things about whether, Cook will step down this year. If he doesn't, if he doesn't step down this year and we get to the end of the year and the Google integration has not actually gone well, then what? Are we still saying like, hey, you're still doing a great job? Yeah. Even though we've missed again on AI, and then you have to hit the reset button and bring someone else in with maybe a new strategy to try and get back on the board with AI. Or maybe we just all, decide AI is not important and that agentic is not important for the phones. I'm going to take the other side of that. For now, it's important. Let's hope that Cook, with his deputies, can execute on this new strategy with Google under the current administration where there's very limitations. They should have all the opportunities in the world to be able to do that. Let's hope they do it by the end of the year.
All right, Walter, great insights. Walter Piecyk, co-founder over at Lightshed Partners, as we continue our coverage here of Apple earnings, up about 2% here in the after-hours trade. It was a record quarter when it comes to iPhone revenue. That's really not a surprise, but obviously a lot of big questions about what goes into that iPhone, if you will, and whether that will keep pace here with some of the other innovations going on in the broader AI tech space. Let's bring Dag Kittlaus into this conversation. He is actually the co-founder of Siri, also of Viv, which of course is basically the backbone of Bixby on the Samsung phone. And Dag, before we kind of talk about the future, I do want to go back in time. And when Steve Jobs came to you, saw your app in the App Store, and at least in his view, at least as the legend has it, he saw something pretty revolutionary. That effectively became the backbone for Siri. It's hard to believe that was, 15 years ago, 16 years ago? And I am curious as to what the evolution of Siri has been and whether it fit with the original vision that Steve Jobs articulated to you back in 2011.
Yeah, so this is an area that Steve was interested in for over a decade. And we actually launched Siri as an app in the App Store back in 2010. And just 2 weeks later, he called us up and invited us over to his house for a conversation. He, like I said, the way he described this was, I finally saw someone who cracked how to use artificial intelligence in a consumer-friendly way. So this was an area of personal interest of his, and so that was the impetus behind, their interest in acquiring the company and everything that's happened subsequently. In terms of where it's at in the development of it. I think we obviously know that there's been, some missteps along the way as it pertains to the execution of consistently making Siri better and making it a bigger part of your life. I don't think there's any question about that, but I'm actually quite optimistic with where they're at today.
Well, I want to talk about where they are at today and where they are going, and not just with Siri specifically, but just overall this idea of a voice or digital AI assistance, if you will, for just regular folks like you and me, or at least me and Katie. You're different. But we get to this idea that I think a lot of us do see the utility in, or the potential in it. What more needs to be put into it to make it as effective as I think some of those early ads made it out to be?
Well, as we speak, Siri's on the operating table right now getting a much-needed brain transplant with this Gemini partnership. So that will bring the intellectual level of Siri up to state-of-the-art. And that's essentially been the limiting factor on how it can help you as a person and as a user get more value out of it. There's some other things we can talk about in terms of how Apple can uniquely take advantage of what Apple does to make this differentiated relative to some of the others. But yeah, I would say, Siri is going to be at the forefront of this almost for free. Having a relationship with Google and with the Gemini integration, they're already getting paid $20 billion a year, and from Google for having Google be the search default on iPhone. And now they have a $1 billion a year deal to get access to the latest and greatest, frontier models in the world. So you can argue that, inadvertently or not, Apple's actually in a pretty good position right now.
Right. Well, I want to talk about that a little bit more because in the last year or so, I saw a quote from you saying that Siri was the last thing that Apple was first on. And then, I'm taking a look at the notes you sent over to us today. And as you say, Apple is inadvertently in a shockingly good place regarding AI. So let's talk about the overall AI stance here, because beyond Siri or, building on Siri, where do you see the green shoots for this company?
Well, let's start with Siri itself. Remember that back a few years ago, when all the AI craze started up with this new breakthrough, companies were putting, hundreds of billions of dollars into this R&D. Now, Apple can come at this with 3 years of hindsight and start targeting, their investments towards things that they're uniquely qualified to do, like client-side versions of LLMs, large language models, the privacy aspect, which is going to be a huge key to, how much people trust Siri and use Siri. And then the channel itself is so huge, despite being behind technically, Siri still has between 500 million and 1 billion users per month. And you don't have to download a thing. All you have to do is update your OS, and all of a sudden you've got an incredibly state-of-the-art Siri right there. And then you start talking about all of the sort of commerce and all the other models things that we had been working on for many years already, like using Siri to buy things, to do things for you. In fact, back in the day, when we were describing this whole virtual assistant idea to venture capitalists and others, we called it a do engine. So right now, if you look at the perspective of all of the different players in this business, almost all the agents are essentially answering questions. There's very few, and we're just starting to see the early signs of them actually being able to do something for you. And I think Apple is uniquely positioned there.
Well, Dag, I also want to broaden this conversation outside of just Apple, because we were talking about this earlier in the show, that you think about OpenAI, it feels like it has tentacles into so many companies in these public equity markets. And of course, the news today from the Wall Street Journal that Amazon also looking to invest a big chunk of change in them as well. You write OpenAI is in trouble. Tell us about that, since obviously that has ripple effects here.
Well, by trouble, I mean, think about who they're competing with. And you can argue which model is the best right now, but there's 2 or 3 that are right at the top. And, OpenAI is the only one of them that doesn't have an existing user base and channel to reach. So, Google search, for example, everybody thought search revenues were going to decline with the advent of this advanced AI. That hasn't happened. Apple's already got a pretty good business. You can see their revenues haven't declined. Siri usage hasn't really declined even since this breakthrough in AI. So, OpenAI, for the first time, last week, decided that they're going to start advertising, which is something they have sworn off as kind of, if you ever see us advertise, you know that we're a little bit desperate. I mean, there's been people that have in the company that have said that. So you could feel they're under the pressure now of spending so much money into this tech without having real revenues behind it, and all of their competitors, generally speaking, maybe with the exception of Anthropic, who's got a focused enterprise strategy, have existing businesses and can just keep investing without the need to worry as much about the commercialization and revenue side.
All right, Dag, really appreciate your time. Really interesting thoughts there. That is Dag Kittlaus. He is co-founder and former CEO of Siri. As we continue to parse these Apple results here, you can see that the stock market reaction pretty positive, but as we've been talking about, this is a company that needed good news. They've been underperforming the S&P 500 and certainly underperforming a whole chunk of their peers as well.
Yeah, and we get to this idea about innovation. I thought 2 interesting things, comments out of Dag and out of Walter Piecyk. Dag talking about the idea that Siri was kind of the last thing Apple was first on. And then Walter also making this idea here that, if you're going to have innovation, you need a leader to help do that. I don't think anybody can impeach the record that Tim Cook has had, of course, taking over back in those early days of 2011 when Steve Jobs, of course, fell ill and eventually passed away. Tim Cook took up the mantle and he kept this company going. It is a cash juggernaut, but there have been a lot of questions here about innovation and whether he is the right guy to continue leading that 16 years into his tenure. It also raises a lot of questions about the longevity of people in those top C-suite roles. Earlier this month, we learned that Apple was expanding the role of its hardware chief. John Turnus to include design work. This raised a lot of speculation that he is now the top candidate to succeed Tim Cook. To talk about the potential for succession over at Apple, as well as CEO succession overall, let's bring in Ty Wiggins. He's the global lead of the CEO and executive transition practice at Reynolds Associates. Ty, great to have you here. First, before we get in specifically into Apple, I just want to get to this idea of the longevity that we've seen in some of these tenures. Steve Jobs is Tim Cook is somewhat unique in this. 16 years, a phenomenal track record, but I was going through all the major CEOs of Fortune 500 companies. If you exclude founders like, Mark Zuckerberg here, he's in pretty rare company of having been able to stay at the helm for that long. Why?
Oh, well, I think whenever you have CEOs that stay past what we expect or what we see as the norm, it has a lot to do with the performance that they're driving through the organization. I mean, you're right. We're actually seeing the average global CEO tenure decrease. It's down from 7.4 years to 7.1 years since 2024. And we're seeing an increase in global exits of CEOs. This year represents a 16% year-on-year increase in CEOs leaving roles. So it is unusual.
When we talk about when the board gets to a point where it says we need to make a switch, usually there's two things. Usually it's some sort of major underperformance in the stock or in the company's bottom line. You don't necessarily have that in Apple. The stock has languished a bit, but I don't think anyone could call it a true underperformer. What are the other reasons, though, where the board would take a look at their CEO and say, you know what, we need to change?
Well, I think from a board's perspective, they want to make sure that they are protecting the base and the organization as is, but also steering a pathway to the future. So after a long tenure, some CEOs can start to lap their own decisions, can start to sort of not be as creative and attentive to the market changes. And so boards will look at that and want to bring in, the next chapter of the organization. And that's where succession is so important, that early in the period, they've started to look at who could take their mantle and who they need to develop and how they develop them. And so moving people between divisions and functions is a fairly classic tactic for succession development.
Right, Ty, that's sort of what I've been wondering about. We talk about the board. Of course, it ultimately comes down to the board when it comes to the succession planning and, elevating the next CEO. But how much of that falls on the current CEO? You think about, like you said, you have to develop a bench here. You could argue that when it comes to really solidifying your legacy, picking the proper successor is a big element there.
I mean, many of the decisions that CEOs make take years to come to fruition. So you get judged, 2, 3, 5, 10 years down the track. And you're right, one of the key aspects of being a successful CEO is that legacy in that succession. Have I left the organization in a better state? Have I left it in better hands? And have I developed the people within the organization, especially, to be able to take it forward and do more and do better with it?
Mm-hmm. And Ty, I have to imagine that, when it comes to motivating CEOs to really develop the bench and develop their successor, a lot of them leave the company with a lot of stock in the company. So it would behoove them to make sure whoever is taking over the ship does a good job when you think about their economic exposure.
Yeah, you certainly see, what we would term as great CEOs. They start thinking about succession essentially when they start. They see it as a key deliverable for their role, and obviously it is the board's decision. But they start working on that very early. They start doing it in a way that provides good optionality across the organization and some security around that as well. So it is absolutely tied to both their legacy and how they will be viewed in terms of their tenure.
I am curious, Ty, before we let you go, just about the search process in general and how involved the current CEO should be in aiding in that search process.
It is a board process. It's a board-run process. So the CEO will, of course, have a view. The decision around it is made by the board. The CEO's responsibility is to make sure that the process is moving effectively. The resources are allocated. The people have the opportunities to grow and develop, and definitely not inhibit any of that progress. But ultimately, the CEO's job is to provide the environment for people to get ready, and it's the board's role to make that decision.
All right, Ty, got to leave it there. Really appreciate you taking the time. That is Ty Wiggins. He is the global lead of the CEO and executive transition practice over at Reynolds Associates, also the author of The New CEO. Meanwhile, we're just minutes away from Apple's earnings call. Let's discuss what to expect with Bloomberg managing editor Mark Gurman. He covers all things Apple. He's the Apple whisperer, and he joins us now. So, Mark, I'm taking a look at the headline on the main bar story right now. You write that Apple sales crush estimates in a record quarter for the iPhone, but then you take a look at the reaction after hours. Apple trying to hang on to its gains, now only higher by about 0.5%. How do you square the reaction with some of the numbers we actually received?
Yeah, I'm not going to try to square stock market reactions with the reality. The reality is that this was a breakthrough quarter, whatever word you want to throw at it. $85 billion of iPhone sales, $143 billion plus of overall revenue, $30 billion in services, $25 billion in Greater China. Are you kidding me? They crushed it. This is just incredible results for them. You know, Apple was in a position where if they missed on here, I mean, the timeline was going to get pretty dark. Tim Cook had already been under fire for all the White House stuff, fair or not, over the last couple weeks or so. The AI strategy is, still MIA. And then on top of that, you miss. I mean, it was going to get pretty nasty, I would say. They just bought themselves a ton of air cover to figure things out. And so the runway here is now going in a very positive direction for Apple.
Well, that's what I'm curious about, too. I mean, no one can really impeach the cash juggernaut that this company is. But it also gets to this idea, Mark, of where sort of the next big product is for Apple, whether it's actual hardware or maybe something that's, something that we haven't even really thought about just yet here. And I guess my question for you is, A, do they need that? 2, are they working on that? And if so, who is working on that?
Well, they definitely need the next big hardware, but more importantly is they need to AIify the iPhone, building it around AI agents, building it around a new version of Siri, building it around the chatbot. That needs to happen, and it's going to happen this year, and that's really phase 1 in this AI comeback. Phase 2, it's not really one next big product, it's a plethora of different devices, wearables, home devices, deeper integration in existing products like the AirPods and the Apple Watch, and it's outfitting the whole line and rebuilding the operating systems around artificial intelligence. So I do anticipate them to do that, but they don't have that in-house technology, and they're going to need to ramp up there and move pretty quickly. Right. OpenAI is going to get into the hardware game here next year. Meta is going to be upping their game with AI wearables and new interfaces and designs as well. You have Microsoft and others playing in that space, but Apple is obviously still the king of hardware, and if they want to remain on top by the margin they're on top by right now, they're going to need to figure out that AI strategy. And I don't think that these massive results, as incredible as they are for the company and investors, should delay those major changes in light of the AI strategy missing.
All right, Mark Gurman, managing editor for us, who covers all things Apple. We just saw Katie Greifeld just want to recap, I think, some of these earnings as we await that conference call at 5 p.m. New York time with Apple. A 16% jump in revenue, we'll just round it up, $144 billion in one single quarter. A profitable company, those profits do continue, but still a lot of big questions about how they keep that going. Is it just through refreshes, or do they need that next big thing?
Also, a lot of questions when it comes to rising costs for memory chips. We were just talking about this when it comes to SanDisk earnings, Western Digital as well. As we were talking about with Matt Bryson, they have pretty strong pricing power right now. That's not great news when it comes to smartphone makers.
The other thing, though, with Apple, too, we always talk about this idea how they have this ecosystem that a lot of the people who have iPhones, they just keep buying new iPhones, So they do have kind of a sort of user base that, to a certain extent, isn't really going anywhere.
Yeah.
And the idea is, what more can they do to leverage that?
Yeah, that moat of that network effect, I mean, that really is the crown jewel of Apple. That's why it works so well. And I mean, even still, though, that this AI strategy, this idea that they're falling behind, that is an existential problem.
That conference call is set to start at the top of the hour. Stay tuned to Bloomberg. Keep your Bloomberg terminal up. Any news that breaks, we'll bring it to you first.